Interest in ETFs, or exchange-traded funds, has exploded in popularity recently in terms of both number of products and assets under management. For example, just in the last 6 years, ETF assets have more than tripled, going from $56 billion to over $175 billion today. Let's look at how an ETF compares to a mutual fund. They're both based on the same principle: diversifying your investment. Rather than tying all of your investment money to a single security, you're investing in a professionally managed pool of securities and you're less exposed to market volatility. So how are they different? The key is in the name. An ETF is an exchange-traded fund. It can be bought and sold on the stock exchange through a brokerage account, whereas a mutual fund cannot. Other differences include flexibility. An ETF can be traded when the market is open, and like any stock, investors can short sell or trade on margin. Pricing. ETF prices fluctuate during the day. In contrast, mutual funds are priced at the end of the trading day, and all investors get the same price. Cost. Mutual funds usually have a minimum investment. In some cases, they also have sales load charges, and they can also have redemption fees. With ETFs, you'll pay a brokerage commission whenever you make a trade. In general, ETFs tend to have lower fees than mutual funds. Transparency. An ETF will typically disclose its underlying holdings more frequently than a mutual fund. This allows investors to know exactly what they're investing in, which helps with asset allocation decisions. Lastly, there is no reason this is an either-or question. Mutual funds can happily live side by side with ETFs in a portfolio.